Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and welcome to the new business day. This is Peter Lewis with Money Talk for Tuesday the 12th of March. Coming up, I have a discussion on the latest business and finance headlines with my panel of expert guests. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's headlines, India will lift most tariffs on 4 nations in Europe in a watershed deal that is expected to yield $100 billion worth of investment over 15 years and 1 million jobs for the world's 5th largest economy. The trade deal with 4 European Free Trade Association nations, which are not part of the EU, will lift most tariffs on several sectors with Switzerland, Iceland, Norway and Liechtenstein. And that free trade agreement has taken 15 years to negotiate. Japan has avoided falling into a technical recession after its official economic growth figures were revised upwards. The revised data shows GDP was 0.4% higher in the last 3 months of 2023 compared to a year earlier. Provisional figures released last month showed GDP contracting 0.4%, the second consecutive quarter of economic contraction. Private consumption, though, which accounts for about 60% of the economy, remained weak, shrinking for the third straight quarter. Hong Kong's stock market regulator has proposed that China lower the threshold for investors to take part in the stock trading link with the city as a way of boosting liquidity in trading. The minimum asset requirement to invest via Stock Connect to access Hong Kong equities should be lowered by 80% to 100,000 yuan. That's about $14,000 from the current 500,000 yuan Securities and Futures Commission Chairman Tim Lu proposed at the gathering of the National People's Congress in Beijing. South Korea's financial market watchdog said on Monday it's found wrongdoings by financial firms selling derivatives linked to a Hong Kong stock market index. The 2-month investigation by the Financial Supervisory Service uncovered poor regulatory compliance and systematic failures regarding the sale of products linked to the Hang Seng China Enterprises Index, it said. The FSS is considering remedies, including penalties and a ban on sales. On today's Money Talk, we're joined by Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, Peter Kim, Head of Global Investment Strategy at KB Financial Group in Seoul, and in Washington, D.C., our US economics correspondent, writer and broadcaster, Barry Wood. And please feel free to get in touch with any questions or comments. Please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks closed lower for a second day on Monday as traders look ahead to the latest figures on consumer price inflation, which is due later today. The broad-based S&P 500 lost 0.1% to 5,118. The Dow added 47 points, that's 0.1% to 38,770. The technology-heavy Nasdaq Composite slipped 0.4% to 16,019. Information technology stocks Supermicro Computer dropped more than 5%, while chipmaker Nvidia swung between gains and losses in another day of choppy trading before closing 2% lower. Nvidia finished down 5.6% Friday in its worst session since late May. Despite that, Nvidia shares still finished up more than 6% on the week, and its market capitalization has increased by $1 trillion since the start of the year. Shares of Meta tumbled 4.4% after Donald Trump described the platform as the enemy of the people. The yield on the US 10-year Treasury note rose 2 basis points to 4.1%, and the US dollar index is hovering near its lowest levels since mid-January, but continued to weaken versus the yen amid an upward revision in Japan's Q4 GDP numbers. The yen was at a 6-week high of 146.94 versus the dollar. Brent crude oil futures were up 0.2% at $82.21 a barrel, and gold prices were hovering just below record highs on Monday. Spot gold gained 0.2% to $2,182 an ounce. Bitcoin rose above $72,000 for the first time Monday, advancing for 6th straight day and taking this year's rally to 70%. Equities in Hong Kong outperformed their peers in Asia on Monday as Chinese technology companies listed in the territory registered strong gains. The Hang Seng Index climbed 234 points, that's 1.4%, to 16,588. The tech index surged 2.9%. On the mainland, Chinese stocks were boosted by data showing China recorded its first month of inflation after 4 months of deflation, with the country's consumer price index climbing 0.7% year-on-year in February. The Shanghai Composite rose 0.7% to close at 3,068. Futures markets pointing for a flat open for the Hang Seng this morning, should start the day around about 16,580. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Well, we have a very international panel on this Tuesday morning, 4 of us scattered all over the world, but the one thing we all have got in common is we're all cold this morning. Starting off in Hong Kong, Mark Michelson, where by Hong Kong standards, it is chilly, isn't it? Chairman of the Asia CEO.
It's chilly, but not freezing. Not freezing.
Okay.
Good morning, everyone.
And I should remind you that Mark's chairman of the Asia CEO Forum at IMA Asia. And in South Korea, in Seoul, where it's always cold, I think, apart from about 2 days in June, we find Peter Kim, who is head of global investment strategy at KB Financial Group in Seoul. Morning, Peter.
Morning from Seoul.
And over in Washington, D.C., where the clocks have just changed, so you would expect it to be spring, but it isn't. We find Barry Wood, our US economics correspondent. Morning, Barry.
Good morning, Peter. And I will add this. I have a prized possession, which is a Turkish knockoff of the American 8th Air Force bomber jackets from the B-17s stationed in England. I thought this was the end, that I'd worn it for the last time this year, this winter. No, I had it out today and was very glad I did have it out because it was cold. It was down to freezing this morning.
Well, here in Manchester in the UK, I can tell you that every year we jump straight from spring directly to autumn. We never have summer in Manchester, so it's permanently cold here. Let's talk about Japan. It might be a bit warmer there. Japan's avoided falling into a technical recession after its official economic growth figures were revised upwards. The revised data show GDP was 0.4% higher in the last 3 months of 2023 compared to a year earlier. Provisional figures released last month show GDP contracting 0.4%. That was the second consecutive quarter of economic contraction, so technically a recession. But the revised figures still came below expectations, as some economists had forecast an upward revision to fourth quarter GDP of around 1%. Private consumption, though, which accounts for about 60% of the Japanese economy, remained weak. It shrank for the third straight quarter. It was down by 0.3%. And Mark, you have a lot of members who do business in Japan, based in Japan. The people that I've been speaking to in Japan have said, actually, this never felt like a recession in the first place. The job market's been quite strong. The Tankan surveys have been pretty good.
Yes, positive.
What are your members saying about Japan?
No. Well, again, and we're going to do a special session. We do special country sessions, and there's been demand to do Japan. I think I've mentioned this before. There is a reconsideration by several members, but several companies of going back to Japan or perhaps increasing their investment in Japan to one sense or another. Obviously, not labor-intensive industries, but areas that that require skills and certain labor and don't cost too much. And Japan's because of the weakness of the yen and other factors, it's become a little bit more attractive. I don't want to oversell this because there's still differences. In Japan's economy, we're forecasting is going to grow about 1% this year. Maybe that's even optimistic, which is less than it did last year. but at the same time, you're right. It's never felt that it's, for most people, it's not felt that it's been in recession. But of course, there are always worries. The bright spots, as you mentioned before, is wages are actually going up. For the first time in a long time. It's been starting with at least the Abe administrations. It's been pushed for many years, and finally it's starting to have some impact. What kind of impact that's going to have in the short to medium term, that's another question. But nonetheless, there are some green shoots as well as worries, and of course one of the worries is still demographics because that hasn't changed in Japan.
Peter, I suppose the interesting thing is, what does the Bank of Japan do, isn't it? And all sorts of rumours about them exiting their negative interest rate policy now that Japan isn't in recession anymore, now that wage growth seems to be accelerating. What do you think?
Yeah, so it so happens that I was in Tokyo for a few days last week. And I must say that I'm going to be a little more aggressive in being optimistic on Japan overall. I haven't seen this much interest, not just from investors, but just the overall outlook on the economy. And it's come from not just the currency, but I think after being what I call low base effect on the Japanese economy for so long, low rates, low growth, and low inflation, you have these green shoots, but number of green shoots, just confidence from companies that things are getting better, consumers. And you mentioned about the structural drag of the birth rate. Even on the birth rates, you'd be shocked to hear that China and South Korea is now below Japan's levels. So if not in absolute terms, but certainly on relative level, the Japan looks much better. And the most important part, I think, is that the global investors are looking for an alternative to China. And there's not many out there, but, a lot of the focus has been on India. But I think the size of the stock market and the liquidity that India provides does not provide one-for-one replacement. And I think Japan is a very viable, liquid, and also valuation-wise cheap. And I think that's clearly very visible walking around Tokyo.
The forecast for Japan raising its interest rates, sort of like the forecast for the U.S. lowering their interest rates. The date keeps moving forward as time goes on, but I think it's going to happen in both cases. But I agree with Peter. There are some green shoots. We don't want to overdo it. The one problem with the aging, of course, is that Japan still is reluctant to let people in from other places. And even if they do let them in, they don't necessarily treat them very well. So this is an issue, I guess, going forward.
If I could just add to what Peter says in Seoul, I'm delighted to hear you say that things look good in Tokyo, and you're on the spot. So that means a lot. It seems to me when you look at the military buildup that's underway in Japan, when you look at TSMC making that big investment in the south of Japan, very near to you in Korea, actually, and generally just the lack of interest in China and a lot of money wondering where to go. I mean, that makes Japan look very attractive. And I'm not surprised to hear you say that, but I think your words mean a lot.
Peter, let me ask you, the Bank of Japan, if it exits, as people are saying, next week, negative interest rate policy, interest rates are minus 0.1%. They've been down there since, 2016. How far do interest rates go, do you think? Does the Bank of Japan just raise them to zero and then that's it? Or do they raise them into positive territory? And if so, how far into positive territory do you think we need to be prepared for interest rates to go?
I call Japan an economy of marginal improvements, and I don't think there is a mid to long term view on the policy path. It's really going to be going for inches by inches and see how the economy reacts. You may recall during the early stages of Abenomics, the economy was starting to improve, and then they imposed this consumption tax, which snuffed out any early signs of economic recovery. So having many of those policy mistakes in the past, I don't think the policymaker is going to draw out a mid to long-term path for any of this. It's really to just gingerly look for lifting off of this, what I call rock bottom base level of growth, inflation, low rates, and to be frank, public expectations. And I think that's what we're going to see. But as I said, low base effect, is already having a very big leverage, amplified reaction on the stock market.
And so is that really the Bank of Japan is, in effect, I don't mean this in a bad way maybe, but it's making it up as it goes along. You say it doesn't have really a long-term strategy here. It's just going to take these small baby steps, see what happens, and tack and turn with the wind.
I would suggest that they've been doing it for past 20 years. So it's going to take them a long time to come out of that habit.
I think longer than that. Just to amplify Peter's mention of the consumption tax, I teach a course called Government and the Economy, and one of the sessions is on Japan, and I have several a slide that shows the various consumption tax rises during the past maybe 20 years. Almost everyone's been done at the wrong time, for one reason or another. Yeah, they have a history of doing that.
I must say, I don't understand yield curve control. I really don't. And when someone speaks of normalizing interest rates in Japan, I don't know what that means either. What I do know is that it sounds very strange to the ear to hear the yen at a 6-week high or 6-month high at 146 to the dollar. My goodness.
Yeah, 6-week high, six-week high. Peter, how do you explain the market reaction though? Yesterday, quite a big sell-off, didn't we? But from what you're both saying, and from what all three of you are saying about the outlook for Japan, it sounds like, from an investment perspective, Japan is still a very good market. So was this sell-off yesterday just a temporary reaction to the strengthening of the yen, or is there something else going on?
The stock market has one common trait across any market nowadays is that any positive or negative gets priced in very quickly, and quite often in the short term it overshoots, and then you have this type of correction. But I think it's very important to understand that global investors, especially long-only funds who are benchmarked on the index, they've been underweight Japan for over 25 years. And you're going to have these structural skeptics who has been watching this value trap. So whenever there is a positive of this kind, if it's indeed a structural shift that we're seeing from Japan, you're going to have a lot of skeptics. And in fact, if you are a believer, that's those skeptics that denies this rally along the way is going to actually ensure sustainability of it. It's going to be longer and a lot more sustainable because there's going to be skeptics all the way through. So I'm actually quite bullish, and I think I might have mentioned last year that I do believe that Japan is actually looking better, at least on a relative basis within the region. And I think from my visit, I feel even stronger on that.
From a valuation perspective, if you look at Japan, it's cheaper now than when it was last at an all-time high back in December 1989.
Yeah. So again, value investors have had a very, very tough time over the past 10 years. You mentioned about NVIDIA just several times during your intro. And I think the fact that value investors so few places to go with these incremental improvements that makes Japan get that much more attention.
Okay, let's switch our attention to the US. Barry, President Biden's unveiled his budget, $7.3 trillion budget plan. It's going to push US debt over 100% of GDP next year, and he's laid out a fiscal agenda that boosts spending but plans to save what he says is $3 trillion through higher taxes over the next 10 years. He's going to sharply raise taxes on corporations and high earners in his second term if he gets one, and he says it's going to help cut the federal deficit, and it's going to pay for new programs to assist those who make less to cope. What are your thoughts on this?
Toss it in the basket. It doesn't mean a thing. I think what I've learned in looking at the Anglo-Saxon world, excluding the United States, budgets mean something. In the United States, the budget, certainly in the last 20 years, means almost nothing with divided government. So here's a $7.3 trillion budget proposal. It will not emerge from the Congress in any shape or form similar to what was submitted. This is a tragedy because in many years, we don't even have a budget. We just have these continuing resolutions. I think the more important elements of the budget, Peter, are the fact that it's still projecting 5% of GDP as a deficit. That's a huge number when you've got a thriving economy as we do. And it's also shocking to think that the deficit will be well over $1 trillion in this budget. And of course, the Republicans spend money just like the Democrats. So the deficit will not close. So it's just another sad revelation of the dysfunction in the United States.
I got the impression, listening to his State of the Union address last week, that Biden's rather frustrated. He feels that the economy is doing well. I think he described it as the envy of the world, didn't he? But doesn't feel like he's getting any credit for that, or his administration's not getting the credit for it. And people just don't seem to feel better about the economy, or if they do, they're not crediting him for it. Was that your impression as well?
Absolutely. Absolutely. And that could change in the next 6 months. I think it probably will change because inflation is on a downtrend, and that's important. But the reason for that mismatch is that prices in supermarkets, particularly for groceries, remain at a very high level. And that's what consumers look at. Jerome Powell said as much the same thing, and that is a problem. So the perception is more strong, more significant than the reality. The reality is we're in better shape on inflation than we were 12, 18, 24 months ago. But the president is not getting credit for it. I think he will eventually, but it hasn't happened yet. By the way, to come back to that State of the Union on Thursday night, the triumph was that the speech came off without a hitch. Yeah. You didn't have an 81-year-old man who stumbled, who physically stumbled, or mentally stumbled. He was in his element. He loved it. He made a few fluffs, but those were not the fluffs of an old person. That anyone could have made those fluffs. They were insignificant. And then to see him 10, 15 minutes beforehand and afterwards in his element in the Congress. He loves people. He loves to schmooze. So that was a big plus for Joe Biden.
And has that convinced the public that were watching? Because there have been concerns, haven't there, about his faculties and his ability to be president for a second term. Do you think that went some way to maybe calming those fears?
Absolutely. Even among Republicans. I don't hear the right-wing talkers emphasizing that, as they wanted to almost every day. And look, it was a sterling performance. It was a campaign speech. Democrats loved it. Republicans hated it. But it was an effective speech.
Mm. Mark, what are your thoughts?
Well, what was interesting that when Barry says that Senator Brett, who made the response from Alabama, who made the response to the speech, emphasized his age and his inability to focus right after the speech, which was almost exactly the opposite, but also almost exactly the opposite of what Peter just described for Japan. The feeling in the U.S. is not positive for many people. And again, the famous slogan that Ronald Reagan used and others before, are you better off than you were 4 years ago? A lot of people don't feel that they were, especially in inflation. And although it's eased, it's better than it was. Barry explained it. That's the situation, and that's what makes the the forecast for what's going to happen in the next few months even more difficult, I'd say.
You know, when I speak to my friends and clients in New York, they talk about inflation. They talk about how restaurant tips have gone up to 25% of all of the spendings. They talk about the refugees that are camped out on the street. It's literally a mirror opposite of Japan. You know, Japan, you mentioned about how they need to bring in more immigration, but Japan, after 25 years of deflation, the public expectations are very low, meaning that their deflationary expectations has been so set that any incremental improvement, they consider it as an upside. Whereas I think U.S., they've gone through this period of inflation, at least in the major cities. The expectation continues to rise. And yet I think the wages and the quality of living is not catching up. So I think that's probably might explain the divergence of the two economies.
And what do you make of the jobs data that we had last week? Added 275,000 jobs, but the thing that stood out was all these revisions. It seems that almost every month the job number is revised down by as much as by a third in some cases, which I sort of struggle to understand how that happens, because it seems to be time and time again, doesn't it, that the monthly job figure, which starts off looking good, sort of gets a bit revised away.
And GDP as well. So, I mean, I don't even know what these forecasts are supposed to mean now, and the short-termism of media coverage on these data. And as you say, 3 months later, they get revised, and you say, what was all that fuss about in the first place then? So the credibility of the economists and their modeling and everything else, I really, I think we all have to maybe take a bit of a reality check on all of this and whether any of it matters. I'm sorry to be a little cynical about this issue.
No, I think you're right to say that. But it is true. If you look at the big picture, Peter, you find that here's a mature economy that is creating a very substantial number of jobs each month. So if it's 3.7% on the unemployment rate and goes to 3.9, this is not a real problem. And you're coming off a very distorted labor force from the pandemic and the work from home movement. So, yes, I mean, what you say, Peter, in Manchester, that is all true. These figures get revised, but I'm not surprised they're revised with substantial differences, because this is a very hard labor force to really read.
And of course, we've got CPI data coming out later today. This is going to be the last bit of inflation data before the Fed meets. Is there going to be any significance to this in terms of changing the Fed's mind about when we're likely to see interest rate cuts? Because they seem to be suggesting we're getting close, don't we? Maybe not quite yet, but soon we're going to start seeing the cuts. Could this all change after tonight?
Well, I do agree. These figures that are coming on the CPI are quite important. If the expectation of a 0.4% rise of consumer prices in February is correct, that would hold the 12-month inflation rate on the CPI at 3.1. That's all right. That would be good news for the Fed. If anything's higher than that, Peter, I think March is already off the table. I mean, we are in March now. It's not going to happen. And the real expectation is the earliest rates will come down is June. And I think that probably makes a lot of sense. It is significant that the Federal Reserve says they'd like to diminish interest rates 3 times in the course of this year. That's assuming that the economy is going to slow. That seems sensible, but let's take them one at a time. And we'll be lucky if we get a rate decline in June.
Mark, we sorely need one in Hong Kong, don't we?
Yeah, and obviously Hong Kong's been affected by it, and certainly sentiment has been affected by it to a great extent. And then we're getting the talk again about, is the link really benefiting Hong Kong, and what are we going to do about it? This isn't new, and I don't think much is going to happen with that. But certainly it's helped reduce sentiment in the U.S. in Hong Kong. So if there is a change, I think that would brighten things a little bit, even though substantially it might not make a whole lot of difference.
Peter, what are your thoughts on the markets? We've got a little bit of a taste over the last couple of days of what a sort of a NVIDIA-led sell-off could look like, haven't we? Because these AI stocks, which have been really roaring ahead, driving the market to all-time highs, suddenly have stumbled a little bit. What are your thoughts?
Well, the U.S. just has defied all forecasts to begin the year. I think even with the assumption that there's going to be a rate cuts and the fact that the rate cut has been delayed, equity market just seems to just see way past that and assume that any downside to the economy is going to be supported by the Fed. So I think that explains the U.S. But I do think that from the beginning, the entire focus has been on the interest rates, and yet all the other policies coming from the U.S. has been accommodative. You have fiscal spending still going through. You have the all the other leveraging mechanisms within the banking sector are still pretty supportive. So I think there has been too much focus on the interest rates. And to be frank, I don't know whether a cut in June or in September even will make that bigger difference to the investor sentiment. I think there's still so much money on the sidelines. I just read that money market funds in the U.S. are $6 trillion, and it keeps rising. Mm-hmm. And that money is looking to go in somewhere. So I think we are seeing a very different type of a cycle this time around.
And Jerome Powell says monetary policy is restrictive at the moment. Do you agree with that? I think, maybe on Wall Street, perhaps they do think it's restrictive. But if you go around sort of factories in the US, I guess you'll get a different answer, that they don't think monetary policy is particularly restrictive at the moment.
No, I think he's trying to talk the market down, because obviously the higher the market goes, the potential for a painful sell-off. But I think, the market is probably calling his bluff, that all this talk ultimately will be withdrawn if the economy or the market softens. So I think it's become a bit of a two sides bluffing, and right now the investors are winning.
Mm. What are your thoughts, Barry? Is monetary policy restrictive? As I say, I guess if you ask a factory worker in Michigan, he'll probably say no. But what are your thoughts?
Well, I think the fact that we have positive interest rates for the first time in 2 decades is an exceedingly positive thing. And I think we're learning to live with positive interest rates. I mean, savers now, for the first time in 2 decades, can get an actual return from putting their money in the bank. That's positive. Is this a restrictive policy? Yes, I think Jerome Powell says that. He would like to ease policy. He probably will, but he's got to see a slowing economy.
Mm-hmm. Mark, let's talk about China a little bit, because the MPC's come to an end now, the week-long session here. I suppose the major thing that came out of it was the 5% growth target. How do your members feel about that?
Well, it's still the same. I mean, the 5% growth target was no big surprise. We're sort of forecasting it might be a little less than 5%, but still reasonable given the size of the economy. But still, same as last year, below expectations, because the hope was that the Chinese economy was going to rebound after the pandemic to a greater extent, and that if not last year, maybe this year we would see signs of strength, and many of them aren't. So, this China plus one is, if anything, accelerating, not getting out of China completely, but looking for alternatives, not only in Asia, as we've mentioned before, but outside of Asia and in Eastern Europe, and especially in places like Mexico, which raises its own issues politically as well as economically, especially with all the Chinese suppliers going there. So I think a very volatile situation. I think most of our members, and you can't speak for all of them, are still committed to China and still see it as important in a variety of different sectors. But at the same time, they're being more cautious than they say would have been a few years ago.
Companies and trade groups are looking, and countries are looking around for alternatives, aren't they? We've got in Germany, Chancellor Scholz has just welcomed the Prime Minister of Malaysia. He's got the Prime Minister of the Philippines and Thailand going there this week as well. And then coming out here, I think we've got some US trade groups, haven't we, coming out to Southeast Asia as well. There seems to be a lot of activity on the trade front, particularly in terms of reorientating supply chains and trying to wean themselves off of China.
Let me just make one mention of that, and I'll let others speak. But our trade secretary, Gina Raimondo, is leading a delegation that's now in the Philippines, and it's going to go to Thailand next. And they've already committed more than $1 billion in investment in the Philippines. In a lot of high tech areas. She's got Microsoft with her. She's got Google, I think. She's got United Airlines. et cetera. And, this is an initiative to try to do something the U.S. has threatened they were going to do for some time, trying to diversify their relationship in Asia. And, ASEAN, maybe it's a little late, but at least you can see that there's a greater focus. Where this will lead, I don't know, but certainly companies, and especially U.S. companies that are involved, are happier now than they perhaps were a year or two ago.
Yeah, I think that's right, Mark. Look, the United States neglected the Pacific Rim. And even though there was talk, even in the Obama administration, pivot to Asia, it really didn't happen.
Point.
But Kurt Campbell, who has been in charge of Asia policy and now is the number 2 person in the State Department, has really engineered, I think, a remarkable turnaround. This is the United States' response to the Belt and Road Initiative. And to go to the Philippines, which had flirted with China very substantially, and now, they have these historic ties to the United States. There are so many Philippine people in the United States, perhaps even more in Hong Kong, but my goodness, this is pushing on an open door. And I think Gina Raimondo and her colleagues are really to be applauded on this one. And as you say, Mark, Southeast Asia has really been neglected when you look down towards Thailand and Singapore, those areas. But my goodness, there's been a real shift in Japan, South Korea, Taiwan, and now the Philippines. This is positive.
Peter, when you look across at China from South Korea, what do you see? We had a lot of targets set over the week of the 2 sessions. The 5% growth target, GDP target, 3% inflation target, 3% target for the fiscal deficit of GDP, but not a lot talked about how this was all going to be achieved. But what was your sense?
More and more I look at China, it seems to center around not the party now, it's around one person, the person we cannot name, right? And I think usually that leads to falling productivity, corporate profits, and growth ultimately. And I cannot see how the quality of the growth can sustain, if not the nominal number that being published. So having been in Asia for a long time now, the shift from a competitive market-driven strategy as a company or a country to a one that's centralized based on politics, it always ends in bad news. And I think eventually you will pay for it through economic growth. As far as the political side of it, South Korea, you might recall me making this point that South Korea got a very early taste of trade wars from 2015 through this incident with China on that issue. And South Korea very, very early on realized that we were shifting into maybe not so much that multilateral trade agreements, but series of bilateral ones. So you actually, when you speak to Korean companies, they've already gotten wind of this thing many years ago. They have no questions that this is a time for localization, dealing with trade agreements country by country and company by company. So I think maybe we're going to have to see that as the new normal.
Mark, are your members concerned about, some of the latest changes we saw at the NPC, which do give President Xi Jinping even more control over every single organ of government? I mean, basically, the Chinese Communist Party has replaced the cabinet, it's replaced the state council, it's replaced, all the normal checks and balances now in terms of how the economy is run and how government is run. It's now about the Communist Party, not the government. The state council, the Parliament really doesn't have any say anymore.
Well, you may remember that maybe it was 10 years ago or so, the State Council cooperated with the international organization. It might have been the World Bank, I don't remember, but a long-term outlook for China that was progressive and very positive. I think it was 2030 or something. Now, that's not going to happen, these sort of things. So I guess to some extent, but, at the same time, the premier in his work report, Li Jiang, was, he sounded a little bit like we're in the middle of our our forecast sessions for our Q1 forecast update, and he said, foundation for continuous recovery and improvement of our economy is still not solid, insufficient demand, overcapacity in some industries, weak societal expectations, and many lingering risks. That's what they're concerned about. And he stated those pretty clearly. And even the push to higher value-added production, especially in tech, that could lead to overcapacity, even greater overcapacity as well. So that's what's affecting companies operating to some extent, not just international companies, but obviously Chinese companies as well.
Is there concern also about a lack of transparency because Premier Chang has cancelled that annual press conference that he normally gives at the end of the MPC, which has been traditional now for decades, and it was really the only opportunity you had to talk about economic policy, ask him questions, and also give him a chance to say what his policy is, and that's been combined with getting harder and harder to get economic data, to get trade data out of the mainland. Is that a concern?
Maybe others can talk about this. Yeah, I think to some extent, probably the most outspoken during those press conferences was Zhu Rongji many years ago, who was pretty aggressive in responding and also was reassuring in some ways in the direction that China was going. It's not been as clear going forward, but now it's going to be. It adds to the opaqueness. And of course, when you don't know what's going on, even to a greater extent, it tends to make you a little bit more concerned.
Peter, do you have a concern about, just trying to get now information about mainland China? Economic data is getting harder and harder to get, isn't it? All sorts of information that you used to be able to get quite easily on services like wind, for example, not so easily available now.
No, I mean, just from the perspective of investors, fund managers and maybe even on the alternative private equity side, this lack of confidence in the data coming through just got to hit to the core. And I think the worse it gets, deep inside, the desire to look for alternatives is going to get stronger. So I don't think there is any way around it. You can talk your way through that China is too big for us to ignore, but it doesn't mean that you keep your investments in there or even thinking about increasing. I think that's really a lot of investors now decided that that's off the table.
Yes, I think you're absolutely right on that. Let's not forget that Zanny Mitzenbotis, who is the editor of The Economist, says China's uninvestable. And Kevin Rudd, the very astute Australian ambassador now to the United States, giving a talk last week at Stanford, saying, look, and he's a Mandarin speaker, that President Xi, in his words, is a Marxist-Leninist who really went after the heads of those major companies like Alibaba and Tencent because he wanted to remind the public at large that nobody is as big as the party or as the president. So these are significant obstacles to resolving some of these matters. And as Peter said from Seoul, the whole business of when you've got that kind of focus on one leader, that can have an economic distorting effect.
So, Peter, what do you do about this market rally? I mean, it's China that's outperforming Asia at the moment. Do you say thank you to the national team and sell them as many shares as you can, or do you go into it?
I think Chinese policymakers still believe in the power of money. If you make investors money, they will come back. I think that may work in the short term. But again, if you had a choice, you would try to prefer to look for alternatives where it gives you a little more confidence over the longer term, transparency, credibility from the policymakers. All that matters. So I think you may have these short-term rallies because ultimately the money's still stuck in there until it has that structural derating, which I think it is happening already. I think the fund flow data still seems to show that the money coming out of China has not been that significant. But I do believe that it will eventually flow out. So the overhang that's sitting on Chinese equities, it's going to be very, very structural, and it could go on for years.
So you think it's going to be very hard to persuade foreign investors to come back into that market? And presumably when they see things like the crackdown that's going on quant funds, I suppose the obvious question as an investor you ask is, well, could it be me next?
Well, so China, over the past 6 months, they tried to package what seemed like a market reform of sorts, but it's been very, very weak attempt at it. To me, as I've been saying for 3 years now, they need political reform over market reform to really convince the investors to come back.
Peter, I think it's appropriate as we end this that toward the end of this, we refer to the Academy Awards, which just happened overnight. Show me the money. Won an Academy Award many years ago, and I guess we're still talking about that.
Well, let me just ask you quickly before we go about this global liquidity surge that we're seeing that's driving everything to record highs, not just stocks. I mean, stocks as well. We've seen them in the US, Europe, around Asia, in Japan, in Taiwan, in Australia at record highs. Bitcoin above $72,000 for the first time. Gold at a record high, rose to a record $2,195 an ounce last week. How do you explain this, Peter?
As I said, we're in this very interesting transition on technology side, but I think there's also overflowing shift in how the millennials and the MZ generation consider investment, and I call it the combination of gaming and gambling. The trading platform that's available on their phones, and the fact that the idea of owning a home is the ultimate investment. I think that is going away, making way for financial products that's really just sort of replacing even cars or homes as the ultimate asset. And I think that structural shift is what has sort of been unlocked during COVID, and it continues. And I think so once again, the idea that's typical interest rate cycle, tightening liquidity, and then you start over, I think that cycle has been marginalized by politics, but also underneath you have this very interesting dynamic on how financial markets interact with the younger generation.
Barry, your thoughts? I mean, there is a lot of liquidity around, isn't there? As Peter was mentioning earlier.
Too much liquidity.
All this money sitting in money market funds. You've got the US government issuing lots of bonds, which the Fed then goes and buys. So that ends up in people's pockets as well. There's huge amounts of liquidity, isn't there?
I agree with Peter. I think that young people think differently, and that's dangerous because investing is not like gambling. It should not be. And central banks have insulated the publics from disaster by injecting too much money into the economy. There's too much money about. And I don't know how this is going to end or if it will end, but we are a globalized world. There's no doubt about it. Money flows where it is welcome. And it's welcome in the States, it's welcome in Europe, it's welcome in South Korea and Japan. And beyond that, those are less important markets.
No, I just reiterate and support what's been said. That's the situation, and it's volatile, and it makes even well, I guess some of our members are investors as well, but it certainly makes the company a little bit more uncertain about what's going on.
Well, thank you all very much. Great to hear your thoughts on a wide range of topics there this morning. Very interesting discussion. You heard Mark Michelson, who is chairman of the Asia CEO Forum at IMA Asia, Peter Kim, head of global investment strategy at KB Financial Group in Seoul, and our US economics correspondent in Washington, D.C., Barry Wood.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening this morning. I'll be back tomorrow with more business and finance headlines. To discuss them, I'll be joined by Enzio von Pfeil, Capital Preservation Specialist at Financial Shield, and James Wong, Chief Executive Officer at Cathasia Securities. With a view from Japan is Dan Kerrigan, CEO of Interactive Brokers Securities in Japan. Please subscribe to my daily newsletter that contains updates on business and finance news from the Asia Pacific region, and you'll find that at peterlewismoneytalk.substack.com. See you tomorrow.
Money Talk